Hey everyone, and thanks for jumping back into the Equityverse. Today, we're going to talk about the S&P 500, and we're going to be providing a general market outlook. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So, sort of the views that we've expressed on the channel for the last several months, just to sort of bring everyone up to speed in case you're new, is we were looking for this correction over here, about a 5 to 10% correction. And the reason for that, as we've expressed previously, was that in pre-election years, we tend to get a seasonal correction by the S&P 500 around that August, September, October timeframe, right? So this is the average of all prior pre-election years, and this is 2023. If you just look at some of the prior pre-election years, here's 2019, here's 2015, here's 2011, right? There tends to be this correction around that Q3 timeframe, sometimes going into October. And really, because of how far extended we were, again, looking at it compared to prior pre-election years, it sort of made me think that it could be up to about a 10% correction in the S&P 500, and that also the bond market would fall during that same time, right? We should see bonds fall as higher for longer finally gets priced in, right? So if we were to overlay the 10-year yield onto this chart, the idea back over here was that higher for longer needed to get priced in. And when it got priced in, when you get a bear steepener, that is bearish, right? It's in the name, right? It's bearish for risk assets when you get a bear steepener. And so that was sort of the view that we're likely going to enter into a time where both stocks and bonds fall. Now, after that correction finished, a few months later, it typically takes like 2 to 3 months. Sometimes it only takes like 1 month. We noted that we are likely going to enter into some favorable seasonality for the S&P 500 going into the end of the year, especially with the bear steepener behind us. Okay, so I actually was quite vocal, especially on ITC Premium, that this was going to be a significant top in the 10-year yield, right? And that bonds were likely bottoming out. And so far, that seems to be the case, right? We've seen the bond market bottom out, and it's up a lot. In fact, you may be surprised to know, I was actually surprised to see this, but if you actually go look at something like TLT, one of the things you'll notice is that it's up from the low. It's up about 20%, 20% move, okay? Now, compare that to the S&P 500 since October. The S&P is up 15%. Now, you might say, well, why don't you pick on something else, right, besides the S&P? The NASDAQ has had one hell of a rally. So let's go look at that. The NASDAQ since October is up about 17 to 18%. So what's fascinating to me is that while we've had an explosive rally in stocks, and we've had the S&P and an explosive rally in the NASDAQ, the bond market has actually outperformed those. And in the same way that we got this bear steepener that was bearish for risk assets, now the bond market going back up and treasury yields falling has been a tailwind for those same assets, okay? And so, this was why, back over here in Q3, I thought we would get a correction and then favorable seasonality going into the end of the year. Now, over the last few videos, it wasn't just the bond market that sort of, led me to believe that there would be some type of rally going into the end of the year. It was also because, and I mentioned this a few times, a month or so ago, Yellen issued shorter duration than the market was expecting. I think that had a big contribution because it was really on around that time where yields started to collapse. And then the other thing was the market, I think, was finally starting to sniff out a Fed pause, right? So if you were to overlay interest rates onto the chart, back in October, I don't know if it was abundantly clear to everyone that the Fed was going to pause. My target for the terminal rate, has been 5.5% for a long time. And so I was more or less under the assumption that they did not need to go any higher, but I was not convinced that they would not. Now, I think a lot of us are quite convinced that they're not going to go any higher, at least not right now. That doesn't mean that they're not making a policy mistake. It's possible that they're making a policy mistake by advertising rate cuts this quickly. But perhaps they're looking at some of the data and maybe they think the economy is slowing down quicker than we would otherwise be led to believe. I mean, if you look at inflation, it is coming down, but a counterpoint to that is the Atlanta Fed is now projecting Q4 GDP back well above 2%. So there's a lot of mixed signals out there, and I mean, a lot of people are quite opinionated on whether the Fed's making a policy mistake or not. I mean, this will be studied for decades, I'm sure, as to whether it's a policy mistake. If there is a hard landing in 2024, I think it would be seen as it would be seen that they're doing the right thing by advertising rate cuts as early as they are. But if there's not, right, if there's not and growth just starts to accelerate and we get another wave of inflation, then I think it would be viewed as a policy mistake. So the S&P has sort of seen this rally and sort of leads to the next question of, well, when would it end, right? First of all, guys, there can be pullbacks at any time. I mean, we're now in this is our 7th green week in a row. So, I mean, I don't really know how often that happens, but I imagine it's not very frequently, especially of this magnitude. When you think about where the S&P was in October, it's now about 15% in about a month and a half, which is not, that's not that common of a thing to witness, like a 15% move. I mean, annual returns for the S&P over the course of an entire year do not tend to be, much more than 12% averaged out. And we've just got a 15% move in a month and a half, okay? And one of the reasons why I think we've seen this is, again, because it's sort of the trifecta, right? Yellen issuing shorter duration, the bond market really bottoming out, which could be tied to the first thing I said, favorable seasonality, and also the market interpreting the Fed as having paused interest rates and reaching the terminal rate. And oftentimes, once the terminal rate is reached, there will be a sizable rally in the S&P. And oftentimes, I think the impulsive rally after a pause can be about 20-25%. And so far, the market's up about 15%. Now, I don't know if it's going to go all the way up 20-25%, but it's possible, right? It's possible if you just look at prior averages. But averages are made up of rallies that are above that level and below that level. And most rallies don't end up just being what the average of all prior rallies are, right? So we do need to consider that. In terms of seasonality, you can really see that there does tend to be continued seasonality, favorable seasonality going into the next couple of weeks. I mean, it certainly doesn't mean that it has to play out like that, but there's definitely a chance that it does. If you were to look at election years, there can be some unfavorable seasonality starting about mid-January, okay? So, and it's interesting because you can really see that averaging out all prior election years, the S&P is kind of flat for the first half of election years. Now, one of the reasons for that is it's not because every election year is bad. I mean, if you look at 2016, we did get an initial sell-off, but then it rallied on up. If you look at 2012, it really wasn't that bad. And you can see that these yearly returns for the S&P back in 2012 and 2016, I mean, they were only about 10%, maybe a little bit more. We just saw a 15% rally in the S&P in a month and a half, right? Election years don't tend to offer the same type of gains on average that pre-election years do. You can sort of visualize that here by looking at pre-election years on the upper line, election years as the bottom line. Now, to really highlight that what we just showed, why on average election years going all the way back to the 1920s tend to not do that well compared to pre-election years, is there have been, and I'm not saying that we have to have one, but there have been a significant number of recessions that actually occur in election years, and and a lot of people have said, well, they'll never let a recession happen in an election year. And it got me thinking, 4 of the last 5 recessions actually were in election years, right? 2020. Yeah, maybe you write that one off is not that relevant, but you still have 2008, you have 2000, you have 1980. I mean, there was also a recession in 1990, but that was not an election year. So 4 of the last 5 recessions actually occurred in election years. And you can really visualize that here. I mean, look at 2000, right? And then look at 2008. These were not great years for the market. In fact, the market ended both of those years down from the yearly open. And then you can go back and look at 1980. It did not end the year down, but you can see kind of early on in the year, there was about a 10% correction. And then it sort of continued, I believe, into 1981, right? So the market did end the year up that year off of the yearly open, but then you had 1981, where then the market sort of fell back in, kind of in line with what it did in 2000. So, that's one of the reasons I think that there has been some unfavorable seasonality. And here's like 1976. I'm going to remove 1980 just so we can kind of see 1976, and then 1972, 1968, right? You can just kind of see some of the different trends. And so, you're looking at a lot of them, and they're not nearly as impressive as what we've often seen in pre-election year averages, right? Because there's several that sort of fall well below that. So in terms of seasonality, right? In terms of seasonality, there is still favorable seasonality until about mid-January, right? So about 1 month from now is when that favorable seasonality might start to fade. But I mean, until then, as long as there's not, some type of major negative catalyst or anything like that, the S&P, I mean, of course, it can have pullbacks along the way. But one of the things to remember is that when the long end of the yield curve falls, especially as quickly as it is, right? When the long end falls, so looking at the 10-year yield, when it falls this quickly, it tends to be stimulative for risk assets, right? And this time has not been different, right? It has been very stimulative for risk assets. And as it continues to drop, it could continue it could continue to have that same effect. Where it could become an issue, and there's no guarantees, right? Where it could become an issue is if it just continues to fall and fall and fall. Because there's a lot of discussions, right, as to whether the Fed, again, is making a mistake by cutting by cutting maybe in early 2024, because it could lead to another wave of inflation. And I think a lot of people are rightfully worried about that. I mean, I think it makes sense to be worried about that. Before I go show you some of those charts again, I just want to remind you, or take another look at just, say, Apple. Because Apple is actually really following its prior pre-election years quite closely. And you can kind of see where it is today compared to all prior pre-election years going back to the 1980s. And, normally it gets one little last pop up into the end of the year. So we'll see if that pans out. And then you look at election years, and you can see that what happens is after about halfway through January, there tends to be some weakness, right? So, which is still about a month away, right? It's still about a month away. But it's just, I mean, to me, it's interesting to look at because, I mean, seasonality does not always play out, right? But it did play out in terms of the Q3 correction. It has played out in terms of sort of the risk rally that we've seen over the last few weeks. But we'll have to keep an eye on what the long end of the yield curve continues to do. And, I think, again, I think people are rightfully concerned about inflation reaccelerating, right? It's not necessarily my base case at the moment, but I mean, it could turn into my base case depending on how the data comes in. I think my base case right now is that there is still a lot of lagged effects that we need to feel from all the rate hikes that have already come through. And, there's a chance that we just haven't felt all of that yet. One way to potentially interpret this is that the market isn't as fearful of inflation at the moment, because if it were, you would expect the long end of the yield curve to go up. A counterpoint to that, though, is that in the short term, markets can often behave irrationally. And even if there is a second wave of inflation, it doesn't mean that the 10-year yield has to immediately go up, right? It could be that, people are not really sure if the Fed's cutting because they see something bad coming, or if they're just cutting because there's political pressure to do so, right? There's just no way to know. And it's also just about, supply and demand as well in the short term. So it's hard to say exactly. I mean, you can always come up with a narrative for everything. So it's easy to assign a narrative, especially in hindsight. But I do think it's relevant to sort of think that just about a month and a half ago, the 10-year yield was at 5%, and now it just broke below 4%, which is a really substantial move to the downside in a very short period of time. And so, we'll have to see if that trend continues or not. Because if it does, then we could reach an inflection point where lower yields is no longer stimulative for risk assets, and they start to worry about, like, why are yields falling? But again, there's no guarantee. I mean, we'll have to see where the 10-year yield settles out, and if it can find support in any of these other prior areas, or if it just continues to collapse, which would theoretically happen if their Fed has gone too far and pushed us into a recession. So a lot of things to consider. So far, the favorable seasonality continues to play out, and we'll see if it sort of shifts gears in a few weeks as we get into mid-January, where that seasonality tends to fade a little bit. And if the bond market were to experience a change in interest, I mean, if the 10-year were to go back up, that would actually potentially be not a great thing for risk assets, just like it wasn't a great thing over here. So a lot of things to consider with the stock market and the bond market and how they all relate to each other. In the short term, as long as bonds are bouncing, as long as the 10-year is falling, it's good for risk assets. The problem is we could reach a point where it's no longer good for risk assets, but who knows, exactly when that'll come. But I mean, this is my general view on the stock market. And again, just to reiterate, while I do provide my outlook on the stock market, my strategy in navigating the stock market, I just buy when the risk on the S&P is below a certain level, right? And for me, it's when it's below 0.7 risk. And then when it's above 0.7 risk, I stop buying and I just sort of wait and see. I just pull back those buys because I'm like, well, normally once it gets pretty heated like that, it's going to get a pullback at some point. And for reference, if we were to go look at the risk on the S&P 500, it takes a little while to load just because it's a lot of data. It's like 100 years of data essentially, and we're loading in the risk levels for all of it. You can see that we've actually recently crossed above 0.7 risk. So, it is getting kind of elevated. It doesn't mean that it can't stay elevated for a long time. I mean, it can, and in historically it has. And there have been times in the past where I would just DCA up to, higher risk levels like 0.7. I've never really done it above 0.75, right? That's really the highest I've ever been okay DCAing into the stock market. And, that might sound like a pretty high level, like 0.7, 0.75, especially if you're into crypto. And that I only DCA historically up to like 0.4, 0.5 risk. But there are some differences with the stock market. The stock market doesn't tend to get like 80% corrections like crypto can often get. And furthermore, the stock market can stay above 0.7 risk for, a really long period of time, right? I mean, here it got above 0.7 risk back in like late 2020 and didn't even come back below it until early 2022. Right. So there are reasons to occasionally buy or DCA up to a higher risk level if you want a little bit more risk. But yeah, just note that the risk level has gone, it is going back up and pretty quickly. I mean, pretty quickly. It was just at about 0.547 risk not too long ago. And I was happy there to pick some of these low expense ratio index funds up. But now it's come back up a lot. And so, the market is getting relatively heated. But again, even though it is getting relatively heated, we could still see that favorable seasonality for at least a few more weeks until mid-January gets here, and then we find maybe some type of more significant pullback in the market. Other than that, I don't really have anything else to say. I mean, there's always other risks that could rear themselves, like if there's geopolitical risk or if there's, a shock in the labor market. But we just got a lot of labor market data recently, and we're not going to be getting a lot more labor market data other than like initial claims and continued claims until early January anyways. So that doesn't really seem to be the biggest risk at the moment. So those are my views on the S&P. I certainly have not gotten every move right this year. I'll be the first to admit that. But at least over the last, 4 to 5 months, it's been more or less going, um, how it would seem like the most likely outcome is just based on seasonality that we've seen in prior pre-election years. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Thank you guys for tuning in. I'll see you next time. Bye.